Hello, ladies and gentlemen. We have made it to the fourth quarter market outlook. And it has not been easy to make it to the fourth quarter this year. The political division, war, inflation, market turmoil, you name it, has certainly made 2022 a year to remember, and not necessarily for the right reasons. My goal with this video is to touch on a few things. First of all, as always, I'm going to talk about what's happened in the global economy and markets so far this year, but I'm also going to get into some topics that seem to be top of mind during most of our client meetings and calls that we've been taking here at CFG. All right, so let's get after it. Per usual, we're going to start with U.S. stocks. They are firmly entrenched in a bear market. Pretty much everywhere you look, stocks are not great here in the United States. And down anywhere from 16% to 35%, depending on which index you look at. We got them all here for you on the chart. We already flagged that continued volatility would likely be present for the foreseeable future, and we don't expect that to change in Q4. At this point, the only sector that's even up on the year is energy. And I'm not talking about wind turbines and solar panels. I'm talking about good old-fashioned carbon. That's the only thing that's making money in the U.S. stock market as a sector this year. And we don't really expect this to change either until sometime early to mid 2023. Moving on to internationals. This time I'm going to kind of lump developed internationals and emerging markets together. Both have been absolutely awful this year. There's really no way to sugarcoat that. While most sell-side economists are still debating whether the U.S. is even in a recession at this point in time, I'd argue that the entire world is in a recession at the moment. As discussed last quarter, the extraordinarily strong dollar is creating headwinds internationally. It'll be good for international trade, but it is absolutely crushing them in terms of inflation. That's why they are experiencing so much higher inflation than the United States, at least on average, is because everything's denominated in dollars. China is still a wild card with this whole recession thing. They've pretty much done it to themselves. All you have to do is look at the recent CCP meeting to highlight this fact. We still view that the risk of war with Taiwan is relatively low in the short term, but current U.S. foreign policy could speed things up depending on how things play out over the next 6 to 12 months. In any event, China is probably still positioned to come out of this global recession faster than any other economy outside of the United States, at least any other major economy. In terms of bonds, they've started a negative slide again. The massive inflation prints in both August and September have triggered significant action by the Fed and very aggressive rhetoric out of the Federal Reserve Chairman Jay Powell. As the Fed continues to surprise investors with the level of hawkishness of their discourse, the bond market is simply just pricing in higher interest rates for a longer period of time. That's kind of the nature of markets in general. They're trying to predict the future. That's what they do. Munis and investment grades are still probably the best place to be in this market. Obviously, we have diversified exposure across all maturities and different types of bonds, but those are probably the safest, at least in the short to intermediate term. For 4 videos in a row now, I'm sure this is not going to surprise you. You're going to see this chart again. This is the 10-2 yield curve. This thing has been inverted for a while. Most sell-side analysts and most advisors don't really give this much credence. But this thing's been significantly inverted for months now. And if I haven't made myself crystal clear in the past, this is not a good thing. In a change of pace, instead of going into all of these data points and really grinding out info on charts, I want to cover some major topics of the day. The first of which is inflation. Secondly, we're going to talk about the war in Ukraine. And then finally, we're going to touch on the election here coming up in less than a month in the United States. So let's go inflation. Newsflash, it is not slowing down yet. It took trillions and trillions of dollars to get to this point. Absolutely amazing, crazy amounts of stimulus and an entire year of supply chain disruptions to create this massive inflation that we have. So it's not just a light switch to turn it off. The Inflation Reduction Act is essentially just tightening supply chains and spending a little bit more money, which normally doesn't help the inflation cause. I don't know what else to tell you. That's not really an opinion thing, it's just a fact. Putting more money into the system through fiscal stimulus in whatever form it takes is not deflationary in nature. The Fed, on the other hand, is certainly raising rates and tightening money supply, which effectively will exacerbate the recession and potentially slow things down. But ultimately, what we need to see is the global economy needs some form of demand destruction to slow inflation. This is macro 101. Less demand and the same number of goods equals lower prices on those goods. This is going to happen, but not until we see more layoffs. The employment data has to get worse. I touched on this on my most recent blog. If you haven't read it yet, do that as soon as you finish this video. There's a link below. Super solid blog, I think, in my humble opinion, but it does draw some parallels between what happened in 2008 and now, and then also talks about this inflation piece just a bit. Higher unemployment, less disposable income, all of these things will push demand down, and in turn, we are going to see inflation start to disinflate or deflate. That's ultimately the goal here. You just don't want it to be extreme coupled with slowing growth environment, because that's not good either. The Fed will see these things happening in tandem. Hopefully, these guys are supposed to be really smart, and that's when they'll slow their rate hiking cycle. And if they don't, the economy will simply get worse until they do. Now let's look outside the U.S. Let's talk about the war in Ukraine. There's a lot to unpack there, so I'm going to try to remain as unbiased as possible in these remarks and just give you some flat facts on the situation. First of all, this invasion was telegraphed nearly a decade ago. The fact that global leaders are out here trying to say this was a big surprise is totally mystifying to me. Obviously, Ukraine wants to be a sovereign country. I mean, they have a right to be a sovereign country as far as rights go. And Russia wants to control Ukraine, which I guess Russia has a right to want to take over another country. I don't really know the moral aspect on all of this in terms of geopolitics, but that's what each country wants. Not that complicated. Candidly, this wouldn't have had much of an effect on the rest of the world had the U.S. and most of the West decided to jump in and provide enormous monetary and military support to Ukraine. To clarify, I am not against this at all. That is not what I'm saying. I'm simply sharing the ramifications of what has already occurred. And those are effectively the U.S. is lighting money on fire and depleting its military stockpiles supporting Ukraine. And American tech and also Ukrainian willpower and fighting prowess has essentially extended this war and potentially even tipped it in Ukraine's favor at this point. Additionally, the sanctions and the aid provided in helping Ukraine defend itself have unequivocally added to inflation. There's no way to argue against that. The irony here, though, is it's Europe that's experiencing the brunt of this, not the U.S., even though essentially the U.S. are the ones that are providing most of the support. From an economic perspective, the best solution would be for the West to stop helping Ukraine and just let the war run its course, and whoever wins, wins. But from a humanitarian perspective, I don't think anybody really knows what the silver bullet is on this thing and how it could be ended peacefully and quickly with the least amount of lives lost. I mean, that is far above my pay grade to try to determine. The only thing that I think is really certain in this is that this war is going to go on for a long, dark time in some way, shape, or form, and the fallout is going to continue to drive inflationary pressures in Europe, and that'll occur even as economic pressures start to subside here in the United States. Heading back over to the U.S., we do have an election coming up, so hey, everybody get out and vote. You know, that's the American thing to do. regardless of where you fall on the political spectrum, this election in general has not been fun to watch. It seems like everybody is getting really, really aggressive, at least in my opinion. Both parties are all over the map, and seemingly neither is producing a consistent platform at this point. If you care about politics at all, you know what I'm talking about. If you don't worry. I'm not going to sit here and outline the entire political platform for both parties. At this point, it kind of looks like, statistically speaking, Republicans are going to take the House. That seems like at least a fairly sure bet if you believe in math. And it looks like the Democrats have the edge in the Senate. This was not necessarily the case a few months ago. It looked like Republicans were going to take both houses of Congress, but that has been flipped on its head at this point in time. Ultimately, what we're looking for here, or I guess what we would look for as a bullish catalyst for the economy, is to have some sort of split government where no party has all of the control. Ultimately, that's what the market likes to see. Some would argue that the liberal propensity for stimulus and spending money is something that's great for the economy. On the other side, you have conservatives saying, hey, deregulation is what stimulates the economy. All of these things have benefits and drawbacks, but ultimately what corporate America wants to see is there being no chance of major changes occurring. That way they can execute on their business plans as efficiently as possible without being kind of blindsided by huge government changes to regulations, tax code, different stimulus, etc. So that's what we're expecting to see, and ultimately I don't think you all have to get too worked up about the outcome, maybe on a personal level, but from a financial perspective, certainly a split government would not be bad for markets. Thank you all for sticking around with me. I really appreciate it. If you guys would like a portfolio review, or if you'd like a free consultation, reach out to our team at info@cfgfinancialplanning.com. We are super grateful for our entire CFG client family, and we are looking forward to a holiday season filled with fun and joy and happiness. And on that note, we are also excited to bring back the CFG Turkey Drive. We're partnering with the Denver Rescue Mission again this year. For each client that brings in a bag of dry goods for a Thanksgiving dinner, we are going to match it with one turkey for each bag of goods. Our record was 55 turkeys from a couple years ago. We're going to beat that this year with your guys' help. Thanks again, and remember, hope is not an investment strategy.